September 15, 2019, Wall Street's most coveted unicorn, WeWork, saw its valuation plunge from a staggering $47 billion to under $10 billion in a single week, and the world watched as the empire of shared desks and glossy lofts crumbled before its very eyes. It began in 2010, when Adam Neumann and Miguel McKelvey opened a modest loft in New York's Soho, offering freelancers a place to work, network, and sip cold brew. The concept was simple: rent out office space by the desk, not the lease, and let members move fluidly between locations. In an era where gig work surged and tech startups demanded flexibility, the idea resonated. By 2014, the brand had a sleek logo, an Instagram-ready aesthetic, and a promise that real estate is the new internet. Venture capitalists, eager to ride the next wave, poured money into the venture, and WeWork's growth chart shot upward like a rocket. Within 3 years, the company expanded from a handful of locations to over 200 spaces across 27 countries. It acquired competitors, its biggest move being the 2015 purchase of the coworking chain Common Desk, and later the 2017 acquisition of the design firm Nodal, which broadened its reach into enterprise-level solutions. The narrative spun by WeWork's leadership was intoxicating: a community-driven, tech-enabled platform that would disrupt commercial real estate, a sector still dominated by brick-and-mortar landlords. The company's IPO filing in August 2019 read like a manifesto, touting 5 million members, a membership model that would generate recurring revenue, and a vision of creating a world where people work, live, and play together. Yet, beneath the glossy marketing decks, warning signs flickered. First, the financials revealed a relentless loss streak. In 2018, WeWork burned through $2.1 billion with a net loss of $1.9 billion, a figure that dwarfed the revenues of many established retailers. Its lease obligations were even more staggering. For every square foot it rented, it pledged to sublease at higher rates, banking on perpetual occupancy growth. The company's balance sheet was laden with long-term lease liabilities that, if unfilled, could become a mountain of debt. Second, corporate governance was a circus. Neumann, the charismatic founder, owned a controlling stake through a series of special voting shares, effectively making him the sole decision-maker. He also rented several of WeWork's properties from himself at above-market rates, a clear conflict of interest that the 2019 S-1 filing disclosed only after investors demanded answers. Critics pointed out his penchant for extravagance, private jets, a private jet named Giraffe, and a personal lifestyle fund that siphoned millions from the company's cash reserves. Third, the tech label was more hype than reality. While WeWork touted proprietary software for space management and community building, the core product remained raw real estate. Unlike true tech firms that scale with minimal marginal costs, every new WeWork location required a fresh lease, build-out, and staff, eroding any economies of scale. When WeWork announced its intention to go public, the market finally peeled back the veneer. Analysts dissected the S-1 and found a company that had spent $2 billion on its own branding, a $1.5 billion venture building arm, and an opaque corporate structure that left investors guessing who truly owned what. The valuation of $47 billion, set by soft money investors in 2017, seemed increasingly detached from reality. As the prospectus circulated, institutional investors grew wary, demanding a 30% discount to the private market price. The board, led by SoftBank's Masayoshi Son, struggled to find a buyer for the company's massive lease liabilities. The tipping point arrived on September 16, 2019, when WeWork's IPO was pulled just days before pricing. The company's stock, slated to trade under the ticker WE, never saw the floor. In the fallout, SoftBank stepped in with a rescue package that slashed the valuation to $8 billion, stripped Neumann of his CEO title, and forced him to relinquish his voting control. Newman's exit came with a $1.7 billion payout, a figure that sparked outrage among employees, many of whom were laid off without severance, and investors who felt betrayed by a founder who seemed more interested in personal branding than fiscal prudence. The aftermath reshaped the coworking landscape. WeWork's occupancy rates fell from a peak of 86% in 2018 to under 70% by early 2020, as startups tightened budgets and larger enterprises reconsidered the cost of flexible leases. The pandemic accelerated the decline, turning open-plan offices into potential health hazards. By 2021, the company had closed hundreds of locations, laid off tens of thousands of staff, and rebranded its remaining operations under the We Company, before eventually reverting to the WeWork name with a leaner, profit-focused strategy. Yet the story didn't end with the company's downsizing. The WeWork saga sent shockwaves through venture capital, prompting a reevaluation of growth at any cost mentalities. SoftBank, once the most aggressive backer, faced its own financial crisis, with the Vision Fund's performance scrutinized by regulators and shareholders. The episode also ignited a broader conversation about corporate governance, especially the dangers of founder-centric structures that blur the lines between personal and company assets. Legislators in the United States and Europe introduced tighter disclosure requirements for SPAC and companies planning IPOs, aiming to protect investors from opaque financial practices. For the millions of freelancers and small businesses who once thrived in bright, communal spaces, the collapse was a personal loss. Many found themselves evicted mid-lease, forced to negotiate with landlords who were suddenly left holding empty spaces. Yet the coworking model survived. Subscribe to The Collapse for more stories like this.